Hannah Kessler.
This gal started her own bank at the age of 18, and then you became a self-made millionaire by the age of 24?
I did.
Hannah Kessler is a money mentor.
She's known as the single millionaire chick.
With advice on how to stop living paycheck to paycheck. Money
Starts with your mindset.
How you think about your money is going to greatly impact how much money that you have.
I grew up in a town called Olathe, Kansas. I'd be walking out of the door, going to school, and my mama would holler at me, "Hannah, make good choices." And I'd have to holler back, "Because the choices I make today will affect my future."
My parents, they did a very good job about teaching me as a child how to handle my money. We have a lack of understanding when it comes to money.
If you want your kids to have money, you need to start talking to them about it while they're young.
I'm really second generation to this concept that's called the infinite banking concept.
And at 18 years old, my dad gave me the choice to start my own bank that then led me to becoming a millionaire by the time I was 24.
Now you've written a book to help tie it all together.
So the companion is really just teaching kids that, not specifically money, but really important life lessons.
Now being the owner of the Money Multiplier, I help serve over 17,000 clients in every state of the country.
Where can people get the book?
HannahKessler.com. Hannah spelled the same way forwards and backwards, Kessler with one S.
Also, I got my podcast show, the Money Multiplier Podcast.
And make good choices today, because the choices you make today will affect your future. Well, good morning, my friends. Y'all, you guys know I love you because out here in Arizona, the sun is not even up yet. Good morning, good morning. I had the craziest dream last night. I've been having the wildest dreams being on the road. I don't know what it is, but last night I had a dream. We were somewhere down South Florida, I want to say, because I was at breakfast and then I came back home to where we were staying at, and there was like a little baby crocodile that was in my room, and I got freaked out because it's a crocodile, but it was so cute. It was a little baby one, and it just really, really wanted to stay with me, and I tried to like get rid of it, and I like threw it in the water just right outside of the room I was staying in, and then it changed, and then it was Piper who was like swimming in the water that I had to go save Piper. It was crazy. I don't know what was going on. But tell me, did y'all have any wild, crazy dreams last night? I want to hear about them as I check the comments. Good morning, Misty. Good to see ya. Annette, good morning. You're probably tuning in from your working place. Hugs and blessings to you as well. Dexter, always good to see you on. And Mr. Thomas, hey man, so good morning to you as well. And he's saying good morning to Daisy. She's sitting just right over here. She's still sleeping. All right. Well, hey, good to be back. As a reminder, I go live every Thursday morning, 9 a.m. Eastern time. And if you can't join us live, you can also catch the replays on my YouTube channels, Hannah Kessler or the Money Multiplier. And you can also see this as a podcast on Money Mornings with Hannah. So wherever you stream your podcast, you can go and find it there. So we are going to get into part 2 of last week's discussion. I know I had Jeremiah Dew on the stage with me last week, and Jay Dew will be with us in Tampa at Money Game Live. Come and join us. I'm getting very excited. As for my people who put on the events, it's the calm before the storm. So it's going to be a great event. Everything's falling perfectly into place. So without further ado, let's kind of get into our part 2 follow-up of the questions I get a lot when it comes to the infinite banking concept. Now, recap on the answers and the questions that we discussed last week. Do I have to keep paying my premium forever? Short answer is no. Can I add a dump in to my policy? The short answer is yes. Can I increase my premiums? Short answer is no. Can I decrease my premiums? Yes. And then we started to get into the topic of what is the base premium and what are the paid up edition riders. So let's kind of start there, okay? The analogy I like to use when we are designing these specially engineered whole life policies for the infinite banking concept. Sometimes we'll refer to them as IBC policies just for short. That's kind of the street lingo, if you will. But to clarify, right, the vehicle that we're using to build our wealth and keep our wealth within our family is a whole life insurance policy with a mutually owned company that pays dividends. But the policy does need to be designed specifically for high immediate cash value. And when I say specifically for high immediate cash value, how you know your policy is designed properly is when you make your premium deposit into that policy, then immediately, my definition of immediately is within 30 days, there's cash value in there that you can start taking out the cash value and using it to pay off debts, pay expenses, pay taxes, and even invest with that money. So how we go in and design the policies, here's the analogy I like to use. Think about your policy like it's a rocket ship. And when you think about this rocket ship, the base of this rocket, that's your base premium. And you'll notice anywhere from 25 to 40% of your premium is going towards that base premium or the base of our rocket. And then attached to the rocket, you got those two booster rockets. All right. The two booster rockets attached onto the side, those are your paid up edition riders. I call them PUA for short, but those paid up editions, there's going to be about anywhere from 60 to 75% of your premium that's going towards those paid up edition riders. So that's why you hear us sometimes say, okay, 40-60. Well, what that means is 40% is going to the base, 60% is going towards those paid up editions, or 25-75, right? 25% of my premiums go into the base, 75% is going towards those paid up editions. I was thinking about this, and for some of y'all who joined us, like Dexter, I know you joined us this past weekend for Chris Nagel's 3-day virtual Becoming Your Own Banker Blueprint event. And I got into the conversation of the mindset and the mechanics behind becoming your own banker and really getting into the specifics of different policy designs and why one operates this way and the other one operates that way. So it is very important, if you're going to get into this realm of being your own banker and you want to start the infinite banking concept, it is just very, very important that you work with somebody that, in my opinion, is affiliated with the Nelson Nash Institute, who is an authorized IBC practitioner. I say it all the time. If you don't like me, you don't like my vibe, that's okay, right? People got different communication styles. You just vibe with people differently. But just make sure that you are working with somebody who is, number one, in my opinion, actively doing this in their own life. I mean, that's my biggest beef. How can you be teaching something to somebody else if you're not actively doing it yourself? But then who has gone through the proper training and education and is really teaching this concept properly. Because something else we got to get into, I need to also touch on the conversation of, hey, can an index universal life policy be used for the infinite banking concept? Let me actually add that to my note. If we got time later on today, or I might even make that like a whole episode on its own, I have some resources that I can share with y'all. IUL for IBC ? All right, for my note. So, right, our rocket ship, base premium in the paid up editions. And sometimes you'll notice, right, if I have to add term to that policy, you're going to sometimes notice that there is a term rider added to the policy. And we discussed this last week as well. Why do we have to add term riders to some policies? Well, it's to avoid the MEC, Modified Endowment Contract. And that term rider allows us to funnel in that extra cash and keep the policy growth and the values tax-free. So we want to prevent a MEC if we can. And hey, actually that's a question I get sometimes. Well, some people get a little anxious, if you will. Am I going to MEC my policy? Hannah, I want to make sure I don't turn this into a MEC. I already send the government enough of my money. I want this all to be tax-free. Well, hey, just FYI, there are precautions set in place that the insurance company, they don't want policies to become a MEC as well. That's just my opinion. Okay. They probably, don't have that in their written language, right? But if you accidentally, Thomas, you can vouch for this. We just talked last week. I saw some emails come through. But if you accidentally MEC your policy, you're going to notice that the insurance company is going to send you a letter in the mail. My dad did this one time. So Brent actually purposely tried to MEC a policy because he just wanted to see what would happen because he's kind of crazy. and And what happened is the insurance company sent him a letter saying, hey, Brent, you told us you don't want this policy to become a modified endowment contract, a MEC. So if you really want it to become a MEC, sign your name here and send us back this letter. But if you don't want it to be a MEC, then here's a return check for the amount of money that your policy cannot hold. So there are some provisions, if you will, set in place so that the insurance company will warn you, hey, just FYI, this policy is about to become a modified endowment contract. All right. Now, what is the minimum to start my infinite banking policy? This is a question I get all the time. What's the minimum to even get started with this? Normally, I say 10 times your age on a monthly premium. All right, that's what I kind of advise is like the minimum to get started inside of your policy. So if I have an individual, let's say they're age 35, okay, 35 years old times 10, add a zero to the end of your age. $350 on a monthly premium. That's the minimum to design the policy properly for this banking concept. However, could I go lower than that? Yeah, you could go lower than that. Matter of fact, my assistant, some of y'all know Matthew Fisher. He is my assistant over here at the Money Multiplier. And something that he told me is he goes, Hannah, the reason that I came to you and wanted to start my policy with you is something that you said on one of the weekly Ask Me Anything webinars, where I could go less than 10 times my age on a monthly premium if I needed to, just because of my cash flow. I know I really, really want to do this, and I just can't do 10 times my age right now. So you can do lesser than 10 times your age on a monthly premium to get started. It's just the only caveat to it is that, hey, in year one, normally if I put $1 into my policy, I'll have access to 60 cents or 60% of whatever I deposit into that policy. So if I go less than 10 times my age, maybe it's not 60% year one, it may be closer to 50 or 40% year one of cash value of whatever I deposited into that policy as my premium. So don't hinder that. I said that a little weird. Don't allow that to hinder you from starting your journey, from taking back the control of your money. Okay, seriously, because it's all about the time value of money. At the end of the day, if I can get my dollars inside of an account where it grows uninterrupted, tax-free, it's protected, the government's out of my hair, I want to get my money inside of that environment where I'm safely warehousing it so I can build up, I can capitalize myself, my money, my banking system, and not have to rely on other people or other financial institutions to finance my life. So just get started, okay? My mentor says that a lot. He says, just get started. You just got to get started and you just got to show up and don't quit. There's actually a one-liner I'm thinking of right now that Dad always says. He says something along the lines of, get started, pay attention, and never quit. I think that's the saying. And if Dad, if you're watching me, you can chime into the chat box, okay? So you just got to get started. So the minimum to start, 10 times your age. Could you go lower than that? Yes, you could go lower than that. What do you recommend, Hannah, that I should start with? So here's my advice on premium deposits into your policy and kind of the starting point, if you will. You know, my story is when I started my infinite banking journey, it was when I was 18 years old. And I was still a waitress at Cracker Barrel back at that time. And back then, Dad taught us as kids, hey, pay yourself first. Okay, so he says that all the time, and he really taught us to pay ourselves first. And I was waitressing, and the cool thing about Cracker Barrel back in the day, I don't know if they still do this now, but I would show up, I would go to work, and I would tend to my tables, and the tip money that I made, that was money that I was able to keep. I mean, I had like a base pay of $2.75 an hour, okay? I mean, like literally all of that just went to taxes. So I had my base of $2.75 an hour, and then really what I made was all my tip money. And every night I would receive my tip money in cash, and I would cash out at the end of the night. And there was no tip sharing at Cracker Barrel. So that was the cool thing. So whatever I made, that was my money. I didn't have to go in there and tip share with anybody. Hear me out. I think tip sharing's a little bogus, okay? Because I don't want to carry the weight. Like, let's say there's somebody who is there waitressing as well, and they're not as good as what I am, right? I don't want to give away my tip money. That's my money. I made that money. So every night I would get cashed out, and they would pay me in cash, and then I would go home and I would count how much I would make. And I remember, I think in a night I would make anywhere from, low nights it would be like $75. High nights it could be anywhere from $250, $300, and that's what I would make every night. And I would pay myself first. So every week I would set aside $100 a week, and I would actually have a shoebox, and I kept it in my closet at my the house that we were renting. I had two girlfriends who were living in downtown Kansas City at the time, and I had this shoebox in my closet, and I would put that $100 into that shoebox every week. And then, so at the end of the month, I would be saving $400 a month. So that's where I started my first policy. Dad says, okay, if you're saving $400 a month, that's where you should start this first policy at. And matter of fact, Dad actually designed that first policy 60 base, 40 paid up editions. And without knowing everything that I know now, I was kind of a little irritated with him when I started that first policy, because I was like, Dad, why did you start my policy this way? I want my money. Now I have to wait even longer to have access to that money. And he was like, Hannah, just shut up, go away. You're going to thank me later in the future. So now I'm back and I'm thanking Dad, hey, thank you for starting my policy 60 base, 40 paid up editions. Because obviously, hey, more money to put towards the base is just going to be longer and more matured cash values in the future versus more premium allocated towards the paid up editions. That's my short-term cash value and short-term thinking, if you will. But hey, there's differences and there's pros and cons to policy designs, because you got to put yourself in that perspective of where that individual is at right now. Like when I'm talking to myself, I talk to myself a lot, okay? But when I'm talking to myself, I'm like, okay, where's this individual at? I saw actually in the comments, Miss Yvonne, good morning, Miss Yvonne. I'm thinking about you. I'm thinking about where you're at in life right now. I'm a lot younger. And I know that I have a lot longer to live with my policies compared to you. And so, yeah, your policy is going to be built with more paid up additions rather than the base because we have need for that cash. You have expenses and you are doing business ventures for yourself and you want more access to that capital and that cash value immediately compared to me, where I'm more concerned about the later years. And I want in the future, 40 years from now, I really want this thing kicking and thriving for myself, right? So no policy is really designed one way because of where people are at or what you're doing with your money. Okay. Debt payoff is a big one. If you're just trying to get out of that financial hamster wheel, yeah, your policy is going to be built with more paid up addition premium rather than the base. But then maybe your second policy is going to be built with more base and not as much to the paid up additions, maybe like a more 40 base, 60 paid up additions, right? So, and you'll notice, it's not just about one policy, right? Nelson always says it's about building a system of policies, building your branch offices of your bank. And you're going to expand as time goes on because for myself, once I left Cracker Barrel, I started working at the Money Multiplier. And I remember the day that Dad called me up and I was in I lived in a fourplex, okay, the little fourplexes in downtown KC. And I remember waking up, I was on the third story floor, and Dad calls me up and he says, "Hey, Hannah, I need help in my business. And if you're not going to help me, I'm going to go find someone else to help me." And I was like, "Okay, well, what do you want me to do?" So I started off by doing applications. I was a part of the application team, helping folks get approved for their policies. And I was working part-time with Dad doing the applications. And then I was working also at Cracker Barrel at nighttime. And I was kind of working both of those jobs. And so my income rose because Dad was paying me to do the applications. And as my income rose, I noticed that then I started to pay myself first $200 a week, $800 a month. So as I was keeping more of that money, all I did is I opened up a second policy, another $400 a month. So then I had a total of $800 monthly cash flow that was going towards my policy premium. So where should you start? In my opinion, you should take a look at your net cash flow, if you will, or you can maybe call it your disposable income, if you will, right? So what I mean by that is look at your income. Okay, let's make believe that you're profiting $10,000 a month. That's your gross income coming in through the door. You're making $10,000 a month, and let's make believe your expenses are $8,000 a month. Well, 10 minus 8 is 2,000. You're keeping the 2,000 somewhere. You're keeping the 2,000 probably in somebody else's bank, the Bank of Wells Fargo, the Bank of America. So instead, take that 2,000 a month that you're keeping, and that's the money that you should start flowing towards your policy as those ongoing premiums. So, and you can pay premiums monthly, quarterly, twice a year, or even annually. And you can always even jump back and forth between those different modes of premium. I actually just paid, I have 3 premiums that come due. I got a January, February, and a March premium that come due at Q1 of this year. And I just paid that February premium. And I now am up to the point where I pay it on an annual basis. All right, $400 a month, $4,800 a year. Wait, did I say 40? Let's back that up. $400 a month, $4,800 a year. So now I'm just up to the point where I pay it on an annual basis. And I try, if I can pay my premium on an annual basis, I like to do that just because as soon as I make that annual premium into the policy, then I have that full cash value for the entire year that's made available to me. So, but it's not a requirement, right? I mean, you don't have to have a large dump in, or you don't have to have an annual premium to start your policy. Again, you just got to get started. I had to have that come to Jesus meeting with one of this, he's a young guy. He's actually 24 years old. And I had to have that same conversation with him. He's like, Hannah, but it's all about the volume and the velocity of money. I need to have this dump in order to start this policy. No, you don't. No, you don't. When was the best time to plant a tree? 20 years ago. When's the next best time? Today. And let me also tell you, Mr. B, okay, I'm not going to say his name, Mr. B, we'll call him. What I'll also tell you, a big quote I hear all the time, people say, Hannah, I wish I knew about this at your age. Or Hannah, I wish I would have started my policy 20 years ago. I hear that all the time because seriously, time is the only resource we don't get back, right? So if I can start this thing at where I'm at right now, because hey, newsflash, shocker, we ain't getting any younger. We're just getting older from this point forward. So if I can start this at the soonest time possible and plant that tree today, I'm just going to reap all the rewards and that fruits of my labor later on in life. So you just got to get started. And that's my advice of where should you start? And take a look at that net cash flow and see how much you're keeping at the end of the month. And that's what I would recommend as the premium that you should start inside of your policy. Good, Mr. Dexter. He's saying, I think about that a lot. Actually, I use that quote a lot. He's saying, I always tell my friends, just get started. Earn while you learn. I remember you told me that back in when we met February of 2020. It was right before COVID. I think it was that week that COVID hit. We were out there in Anaheim at the Noteworthy events. That's where we met. And we sat down, me and you, and then also your brother was there. So policy increases as you're learning the process. Absolutely. So earn as you learn. Hey, Dexter, we need to make that a t-shirt. We need to sew it on a pillow. Seeing some of these comments. Margaret's coming in from Northern California. Good morning, early bird. Oh, thank you. I'm a ray of sunshine this morning. All right. So what do you recommend I start with? Here's one. What is the risk in practicing infinite banking and buying a whole life policy? I love this question. What is the risk? Well, the biggest risk factor in all of this is you and how you use your policy. And who do you know better than you? I mean, seriously, you are the biggest risk factor in all of this. So you and how disciplined you are, how you manage your cash flow, how you review your finances. Every month, the first Wednesday of every single month, I will go inside of my portfolio and I will update my net worth sheet. I look at this thing every single month. Okay. And that's my biggest encouragement to y'all. Go in there and really see what your cash or your financial life is doing. Because I don't know about you, like seriously, later on, like at the end of January, for some reason, I was getting anxious. I was getting anxious about my money. And I think the reason I was getting anxious is because I did change myself. So compared to last year, I have my LLC, right? And my old tax professional was supposed to have my LLC be taxed as an S corp, but she didn't do that. So I fired her, and now I have my amazing, I love him, third time's a charm, a tax professional who has shifted me over to an S corp, and I have to pay myself, me the person, a payroll every month. And so I was getting a little anxious because I have to pay out that payroll, then there's taxes, and then you have to pay the payroll processing company their fees. And, it was just a different flow of how my money was operating. So I was getting like a little anxious, right? But all I did is I went into my net worth sheet. I looked at all my bank accounts, I looked at all my policies, I looked at all of my investments, and I updated it. So I actually updated my net worth sheet a little bit earlier in the month than what I do. And I calmed. It really calmed me once I knew what was going on. Quote Nelson Nash, if you know what's going on, you'll know what to do. So if you are starting to feel a little bit anxious with your money and your financial life, just take some time to sit down and just look over your bank statements, your credit card statements, and see what's actually happening. Because when you are flying through that black box, you're going to get anxious. You don't know where you're going. It's almost like, using my pilot analogy, it's almost like flying through the clouds without your instruments, and you don't have all the instruments down here. There's no visuals. You can't see anything, and all of your tools are messed up, and you're like hoping and praying that you don't run into something. So don't do that. Calm yourself. Again, you're in control of this. You're in control of your financial life. Who's going to care more about your financial life than you? I mean, seriously. So really, the biggest risk factor in all of this is you and how you use the policy and how you use your money. If you don't capitalize your policy, you're not paying your paid up edition premiums, it's just going to hinder you. If you don't pay the loan interest on your policy, it's just going to hinder you, right? And who controls all of that? You. At the insurance company level, in my opinion, it's the best place to warehouse my money. I said this last week. The only difference between a commercial bank and a mutually owned life insurance company is the name on the front door. They're both places of where you can store your money at. Why do I feel safer keeping my wealth with the insurance company? Well, because they're not as risky as commercial banks are. But hey, why do we go keep our money down at the local bank? Well, that's just where they keep the money at. That's where my parents are warehousing their money. That's where my boss, my friends, my colleagues, my coworkers, that's just where everybody's keeping the money at. So that's why I keep it there. Anyways, so why I feel safer keeping my wealth at the insurance company is because they're not in the risky business practices like commercial banks are. Okay, I mean, commercial banks are issuing loans to, let's say, low-income families, right? For mortgages, maybe. They're funding startups for businesses. They're more riskier investments that they're making. And then on top of that, because fractional reserve lending, for every $1 that we, the depositor, keep at the local bank, that bank can now lend out $8, $9, $10 for every $1 that it holds backhand on its reserves. The insurance company doesn't do that. They're not playing that same game, because at the end of the day, we are walking into a contractual agreement with this insurance company saying, hey, if you pay me these premiums, the insurance company, if you pay me these policy premiums, I have to guarantee you this interest on your cash value. And I also have to guarantee you this death benefit. And so I got to make sure that I have that money to pay your family or pay you, the policy owner, when you want to take out a policy loan, because contractually, you as the policy owner, you hold first rights to any cash value that's inside of your policy. So I got to make sure that I have that cash on hand when you request it or when you need it. And what the insurance companies are doing are playing a different game of really the Austrian school of thought, Austrian economics. So for every $1 that it holds backhand on their reserves, they cannot lend out more money than what they have on hand. $1 has to protect $1. And then they do, they go out and they make their own investments. They do a lot in bonds, long-term conservative bonds. They're really locking in those rates, right? And then they do some real estate, shopping centers, sporting arenas, and then they're keeping cash on hand when policy owners want to take out loans. And they also are keeping cash on hand when they got to pay out the death claim. So, sorry, I'm reading some of the comments that are coming in. ADD brain. So that's why I feel safer keeping my wealth with the insurance companies compared to these commercial banks, because of how they operate. And go back through history. I mean, don't just take my word for it. Go look it up. Go see how long these insurance companies have been paying out a surplus in dividends to all of their policy holders when the times of 2008, Civil War, Great Depression. I mean, they were still paying out dividends to policy holders when everything else was up in dumpster fire flames, is what I say. So that's why I feel safer keeping my wealth there. And it's kind of a perfect segue into the next question I get a lot is what insurance companies and why this specific company. The companies that I personally do business with, One America, ONE America, based out of Indianapolis, great company. Lafayette Life. Lafayette Life is based out of Cincinnati. They're part of a larger company called Western and Southern. For all my Cincy people, have you guys ever been to the Western and Southern Open? I went one year. I think that was in 24, 23 with mom and dad. That was a lot of fun. But Lafayette Life is a great company. Security Mutual Life, SML, we call them, based out of Binghamton. I can never say that word. Binghamton, New York. I use them a lot for my New York folks because I hate to break it to you, New Yorkers. Not a lot of people like doing business in the great state of New York. So it kind of limits us to what companies we can write with if you are in New York. But SML is a great company, Security Mutual Life. And then I kind of have like my backup companies, Penn Mutual, PENN Mutual. They're a great company. Mass Mutual, the big name. Everyone knows Mass Mutual, I would say, based on the commercials that you see, right? And then also Guardian. Guardian is a great, strong, mutually owned company as well. And then there's other like companies, like Foresters is a great company. There's Emeritus. They're a great company. There's Mutual Trust Life. They're a great company. So you just want to work with a company that, number one, is mutual, number two, allows you to design this policy this way with those paid up edition riders, and then in my opinion, number three, allows you to take out that loan immediately from your policy. So to segue into that next question, why this specific company, is because sometimes these companies will have funky little quirks where there's a big company out there. A lot of people know them. I don't personally love them. They're a great, strong, mutually owned company, but they don't allow me to have access to my cash value immediately within 30 days. So why would I go with that company compared to this other one, One America, Lafayette Security Mutual, where they do allow me access to my cash value immediately, right? So it kind of has a little bit of quirks like that. And then also even quirks as in loan interest rates. That company in specific that I'm referring to, their loan interest rate is at an 8%. Well, hey, I have other companies that will allow me to access this cash value in the form of a loan at a 5% interest rate. So I'd rather go with my 5% interest rate compared to the 8% interest rate, right? So that's why we kind of use these different companies. And then also specifically for people, if I have somebody who's going to have their policy be designed like $100,000 year one dump in, and then they want to drop it down to $10,000 a year for the ongoing premium, Lafayette Life's going to cater more to that policy design compared to like One America. I'm just allowed to do more of that higher dump in over there compared to them. But One America still allows us to do a dump in. It just means my ongoing premiums have to be a little bit higher, right? So that even kind of pivots me to one company over the others for folks. Age could play a factor into it, right? Some companies cater better towards higher ages compared to my other companies. And even health concerns, health concerns can play a factor into one company over the other. So that's why I do a lot of my what's called your field underwriting. That's some other insurance lingo of just qualifying that person, So if I have somebody, I'm thinking about this one case in particular, she has a criminal history and she has a felony. And so I said, hey, let's go check with the insurance companies before we just submit this, because let's see if they'll even consider you right now. And, thank goodness that felony was 30 years ago. So as long as the felony, depending on what the charge is, as long as it's 10 years from the end date of your probation, insurance companies will consider you. So don't just think that, because I have a criminal history, or, because I have this long, extensive health history, that I cannot get approved or I cannot qualify for this policy. And just quickly, right, even if you can't be considered for a policy, remember, you can always put the policy on somebody else that you have an invested interest in. Okay, I share a lot about my older brother having a kidney transplant. no insurance company will touch him right now. So he puts policies on his key employees in his business. He has a wife. He's got 2 kids. He owns policies on all of them. And that's how he's still able to implement the infinite banking concept, because he puts those policies on other people. All right, let's see some of these questions that are rolling in. Dave says, I started my first policy 30 years ago. Unfortunately, did not have the knowledge that was set up incorrectly and lost the policy in 2009 because it was not a whole life. Dave, and actually you bring up a good point too. Even a policy that's not designed on the initial forefront for the infinite banking concept, if it's got some age and maturity on it, whole life policies, okay, I'm talking specifically about whole life. If it's got some age and maturity on it, you can use that policy because it's got cash value in there. Whole life has always built up cash value and equity inside of it. All we're doing is we're just overfunding it with those paid up edition riders, and that's how and why we have cash value immediately. Oh, and he's saying, so glad a good friend introduced me to the Money Multiplier team. Thank you, Dave. We're good. We're happy to have you. And I'm going to see you later this month too. Which is kind of a perfect segue. Let me go to a quick commercial break, and then I'm going to come back and I'm going to answer your questions that you are putting in the chat. Okay, so keep the questions coming in. I will answer them. I'll be right back.
Hey, I'm Hannah Kessler with the Money Multiplier.
And I'm Larry Steinhaus, CEO of Investor Schooling.
Yeah, you are, man.
Yeah.
Last year, our VIPs got something special. We took them on a private tour of one of...
so cool.
It was cool. Of one of your investment
That's right.
properties.
It was my mobile home park.
Mobile home park. Over double-digit returns every single year. And for you, we're going to get deeper into how you even bought it, financed it, how you putting tenants in there.
And how cool is that? We didn't just do numbers, right? They show the strategy in real life. They show how to deal with the structure, where the income came from, and how it all work together.
And VIP access isn't just better seating. It's about being in the right room with the right people.
You know, there were some really cool conversations that went on in that VIP event, remember?
Yeah.
There was like people had problems, we had solutions for them. Yeah. I think there was at least 2 people who bought major properties right after that VIP event.
They did. And I know exactly who you're thinking of too.
Yep.
You guys need to be in the room. If you've been waiting for a sign, here's your sign. MoneyGameLive.com.
Always go VIP.
So Money Game Live is coming up. So that's where I'm going to see you, Mr. Dave, later on this month. So come and join us. Tickets are going fast. And VIP, y'all, I am almost sold out. So just FYI, I have some fun things planned. And come and join us, MoneyGameLive.com. Okay, getting into the comments here. Margaret is asking, for us latecomers, is it best to make up with a larger dump in? I mean, if I have extra capital, of course, right? Because at the end of the day, the whole idea is run the money through the policy first. My first step, just add the one additional step. That's all that we're doing. Run your money through the policy first and then take it out to go and make your investments, pay off your debts, pay your expenses. So for us latecomers, it's best excuse me, is it best to make up with the larger dump in? I mean, yeah, but also do I have to have it? No, okay? I know a lot of people who are later stages of life. I'm thinking of one gentleman right now who didn't have a dump in, but literally this week, 8-minute phone call because he understands this stuff. He's like, Hannah, I'm going to take some of this money out of my IRA because I'm in my 60s. I'm past the 59 and a half. So I don't have to pay the 10% penalty. I still have to pay tax on the money anyways. So I'm just going to take that money out because I need to go buy myself a new car. So instead of just paying cash for the car, I'm going to do a dump in into this new policy. And then I'm going to take the cash out and then I'm going to go buy that car. So really, do I have to have it? No. If I have it, should I do it? Sure. I mean, up to this point with my 8 policies and when I'm having a conversation with myself of, am I ready to start an additional policy? I will work it backwards, okay? Because remember, I look at my finances every month and I see how much am I keeping. And if I see that keeping money on an inclining trail, I will set that as my ongoing premium. And then I'll take a look at my bank accounts and where I'm storing my money at, and I will see where I could take some of that money and then do a dump into that policy. So that would be my response. Lisa. Hey, Lisa, I want to tell you, I took this on the road with me. You know what I'm referring to. I loved your message in here, and it's really great words of encouragement, so I take it with me. So when I'm feeling down, I read your words. Just FYI. Love you, girlfriend. Lisa is asking, your analogies and stories help with understanding. Right now, I have investments not paying. I just want to store my money in a policy. I want my money to safely grow my policy. I'm sorry to hear that. And hopefully, Lisa, you got the collateral there, okay? That's my number one advice. I mean, never loan out money unless you have collateral is secured to back that investment, because worst thing, if that investment goes south, you have the collateral. And me right now in my investment portfolio, I'm just 100% private lending. This year, I want to get into different asset classes, whether I've been kind of toying around with like residential assisted living really interests me. Storage units interest me as well. Turnkey rentals too. More so, I want depreciation. That's really what I want. I mean, lending is so great for cash flow monthly, but it doesn't really help on my tax side. So I really want to get deeper into finding investments to help me on the tax purposes. Oil and gas is a great one. Courtney is going to be out in Tampa as well, sharing oil and gas and how we can get depreciation from that investment and get monthly cash flow. But here's something actually my dad said. He said he doesn't freak out. Like, and if an investment doesn't pay out, number one, he has got the collateral, but he's like, hey, I took the money from my policy and my money is still growing in my policy, even though I took it out and I went and did that investment. So, okay, this investor is not paying me back right now, but it's okay because my money never left my policy. Because remember, you're not using your money. We're taking out policy loans. We're using the insurance company's money in the real world. And that's how and why your money is still growing and compounding as if it wasn't even touched. So that's the good news. I mean, you're still earning your guaranteed interest and dividends on your money, even though that investor's not paying you. You're not losing because you're still earning that uninterrupted compounding inside of that policy. Good morning, Miss Yvonne. Can you explain how to use a segregated checking account? I should have one when I get my policy. Well, that's a good question. This is actually another good FAQ question I get a lot too. Segregated checking account. Is it a requirement to have one? No. Is it helpful? In my opinion, yes. I actually have a bank account that I titled Pay Myself First. Okay? Because there's two reasons that I have this segregated checking account. Number one, it keeps me disciplined. I pay myself first, okay? Totally excluding the policies out of it. Treat yourself as your number one asset. You pay yourself first and then go pay everybody else next. The house people, the car people, Bobby's soccer practice, Susie's piano lessons, the grocery bill, the gasoline bill, the electric bill, the phone bill, right? Pay yourself first and then go pay everybody else next. Because how most people operate is they go pay all of their bills, they go pay everybody else first, and then they just hope and wait that there's money left over for them. Stop it. Treat yourself as your number one asset. Pay yourself first. So I use that segregated checking account as pay myself first to keep myself disciplined. And when I say segregated checking account, it's just another checking account, bank account that I opened at the bank that I do business with. And even you don't have to open up like a whole new account. I mean, if you have like another account, like even if it's just a savings account, just an account that's not tied to your main account of where you get paid at, a separate segregated account aside from your main account. And the reason that we use it is pay yourself first. But then also when I receive any loan money out of my policy, that money gets deposited into my segregated checking account, because come tax time, loan money is not taxable, right? Any policy money that comes out of our policy, I just said any money, well, okay, that's a whole other conversation. When you withdraw the money, if you're below cost basis, it's tax-free. If you start withdrawing over cost basis, then it could become taxable. But loan money, even in traditional sense, loan money is never taxable. So to keep it easy come tax time, which we're right here, right at the height of it, okay, April 15th is coming up, or if you're like me, you're going to push those extensions out to October 15th. It's easy to identify what's taxable income and what's not if I just keep the two accounts separate, my main account and my segregated account, and have all of my loan money get deposited into my segregated account, because then I can easily identify what's taxable income and what's not. But is it a requirement to do so? No, it's not a requirement. Do I recommend it? Yeah, I do recommend it. Extra money on hand, your strategy, your opinion. Do you pay premium or decrease loan? Okay, no, this is a good question, Dexter. Here's what I like to do. Number one, always max out any extra paid up edition premium I can. So if your policy can hold extra PUA premium, max out those first, because then you're just adding to that cash bucket, and now your bucket is more, and thus it's compounding on more. So I always suggest pay those paid up edition premiums, or change your mode of premium. If you're doing monthly, you can switch it to quarterly, semi-annual, or annually, and that's a way that you can get more monies flowed through the policy. And then once you max out your first policy and it can't hold anything else, then maybe my second advice, start thinking about policy number 2, but maybe you're not ready for policy number 2 yet. Maybe you are not creating more of that cash flow every month. Then what I would do is pay back your policy loan. So the times that I pay back my policy loans is, number one, when I am being disciplined with myself. If I go, like, actually this van, right? Bought this van and I'm paying myself back for it. So obviously I'm being an honest banker, pay myself back with interest. But when I'm also doing it in my investment lifestyle, sometimes I'm not paying back my policy loan, because, okay, insurance company, who cares if you're going to charge me 5%, because I know how to turn around and make no less than 12% on the money, right? But if I have no active use for my capital, or if I'm saving up for something, I will go and put the money back towards the policy, pay back my policy loans. So now it's in a safe place, being held in warehouse somewhere. So don't be afraid to pay back your policy loans is a big PSA, I guess I also want to say, because anytime you pay back your policy loan, it's just going to show up as cash available again back inside of your policy. Yep. Hopefully I answered that. Dexter, chime in if I did not answer that correctly. Okay. Let's see. Why the specific company? We discussed that. Hey, actually, Yvonne, kind of to follow up to your question about the segregated checking account, how does money flow in and out of the policy? It's an ACH, right? Okay, an ACH, or direct deposit. Premiums will get deposited into the policy, ACH, and then when money comes back out of the policy, it'll get deposited into whatever bank account you told the insurance company you want that money deposited in. Now, something else too, people ask me, Hannah, does it really take 30 days for me to access the cash value? Real answer, no. I tell you within 30 days, because I don't want y'all to get mad at me when your loan money, if I tell you 10 days and your loan money shows up in 12, you know? But I mean, real time frame, like when I'm requesting my policy loans, I'm seeing that loan money show up inside my bank account anywhere from 3 to 7 business days. Okay, so my biggest advice is give yourself a week at minimum from the time that you actually need the money to go and request that policy loan. Now, given if you don't do direct deposit, the insurance company will just send you a paper check in the mail. Okay, so that's another way of how you can get money back out. Send them a paper check to pay your premium. They'll send you back your loan money in a paper check to your house, right? And address it to the policy owner. So ACH or paper check is how money gets in and out of policies. All right, last one I wanted to touch on. And then I think I answered my question earlier today about the IUL for infinite banking. Short answer is no. If people are coming to you saying that an index universal life can be used for the infinite banking concept, write into me. I got a lot of resources I can send you of why they should never be used for the infinite banking concept. So we'll wait and we'll do a whole episode on that topic. Dexter, you can even chime in. Like this past weekend, I showed a real life IUL illustration, a 12-year-old policy where, I mean, guaranteed side and even on the non-guaranteed side, the policy lapses on itself. I mean, I have a pet peeve about IULs for infinite banking. But the last thing I want to get into is the implementation team. Y'all, for you folks who have policies with the Money Multiplier team, you have your implementation agent. And I can't stress to you enough how important it is to follow up with your implementation agent. Okay, I know that it's a free service that we do for y'all. And I know that people don't value free all the time, but seriously, get connected with your implementation people. When they reach out to you, set up a meeting, schedule that phone call, schedule the Zoom call, because they are building you tools, visual tools to help you use your policy. And they're updating those tools as time goes on. And this is life, right? We're going to have windfalls. We're going to have downfalls. We're going to have raises. We're going to have demotions. And we need to stay updated with what's going on within your financial life. And the more that I know about you, the better I can help you. Okay. Just yesterday, I spent almost 3 hours on the phone with 2 people because these 2 people wanted to quit their policies. I went into the notes on the implementation team and I was looking at them and I'm like, oh, okay. It's been 2.5 years and you have never talked to your implementation agent except that first time that they reached out to you. So once you start to get out of the campfire and you start listening to all the noise that's going on out there, y'all, there's a lot of noise. There's a lot of noise going on. And I get it. People have their own opinions about what you should be doing with your money. I mean, even like a young guy, if you guys know Caleb Hammer on YouTube, he does these really cool personal financial audits. And it's really, he's got a sassiness to him that I really like. And he really gets in their face and he kind of grills these people about how they're spending their money. But he was talking to this one girl. Go to Chris Nagel's TikTok page and he did a response video to this. But he was talking to this one girl. You're putting money into this whole life policy. Well, why are you doing that? You could get higher rates of return by taking that money and investing it in the market and then just buying yourself term insurance. Oh my gosh, like even him, even this guy who's got this huge platform, almost like a Dave Ramsey's disciple, is out there preaching buy term and invest the difference. Hey, you should go in and cancel this whole life policy. Why would you ever cancel a guaranteed appreciating assets? I mean, seriously, guaranteed appreciating, and it's not tied to market volatility. It's not tied to government intervention. So anyways, back to these 2 people I spent 3 hours talking to on the phone when I could have spent those 3 hours at a national park. Sorry. Once we got back into it, they're like, okay, yep, you're right. I need to keep these policies. I need to be hanging around the campfire. I need to keep drinking the Kool-Aid, hanging around the community. And, they're keeping their policies now because they understand what they actually have. And so my biggest PSA, y'all, just get connected with your implementation agent. I am always here as well. Okay, I spend a lot of time in my days talking with folks about their policies, even multiple policies that they have. And really, when people get into this, so that's why I personally did that phone call with them, because people do not quit. I mean, when you are year 4, 5, 6 into this stuff, when you put $1 into that policy and it's spitting back $1 plus some, why would you ever want to stop that system and the compounding growth on that money? I mean, seriously. So now they're good, they're handled, and we're having some implementation meetings. We had to kind of have that come to Jesus meeting and say, hey, we're here to help you, but I'm willing to run 80 yards down the football field. You just got to come and meet me at the 20-yard line. I mean, seriously, we're willing to go the extra mile and go that far for y'all. But at some point, you got to take ownership and responsibility in your own financial life, and you need to take this stuff seriously. I'm going to coach you on how to fish, but at some point, I'm going to give the fishing rod to you. You're going to have to throw out the rod and the fishing line, and you're going to have to reel the fish back in, because it's your financial life. I told the guys, I said, I don't care if you stop your policy. I've already gotten paid on your policy, okay? It's not about me whatsoever. I have already gotten paid. But this is about you and your financial health, and I don't want you to stop this because you are not hanging around, you're listening to the noise, you're listening to your broke ass brother-in-law. I mean, seriously. So when you get with the implementation team, they're going to say, okay, this is step 1. Here's where we're going to start. This is step 1. All right, now that we've completed step 1, this is going to be step 2. This is what you need to do now. And they're going to guide you. They're going to be there to be your guide, okay? So get with them. He's saying, you go, Hannah Kelsey. Hey, good morning, Mr. Justin. Took me a year to get the basics of the concept, and now I'm still learning the ins and outs since you guys explain new stuff with the policy. I love it. Oh, thank you, Justin. I bet you're working on some cars right now. Dexter is right. Learn while you earn. His saying always sticks with me since he said it at the Money Tank. Appreciate you, bro. Well, good, y'all. Good. Hey, and that's the cool thing, too. I mean, I'm going to do another plug here. Come out to Tampa, y'all. MoneyGameLive.com. Come out, because you will create friendships. You'll create relationships, even business relationships. You know, that's a cool thing about the community here is that we got a lot of people who have their specific, what do I want to say? Their specific expertise. That's the word. They have their specific expertise in these different asset classes or mindsets that they may have. And when you get around those like-minded people, it's game changer. I was on the phone with my she's 16. 17. She's gonna be 17 in May. 16-year-old niece, Tori. And I said, Tori, you know, because she called me up, and I need to talk with her more. Tori and I are going to talk more and more, but she wanted to talk to me because she's going through some stuff in life, and she just wanted to bounce ideas off of me. And I was like, I feel so honored. I was like, is this what it feels like to be a mom? And when your kids come to you asking for your advice, you're like, they think I'm cool. They want to come and hear my opinion. But Tori just had some stuff that's going on at school, going on at her home life, and she just wanted to talk to me about it. And then we got into the conversation because she's not, she has this one friend that she's not my favorite friend, okay, personally. And I was saying, hey, are you still hanging out with that one girl? And she says, no, not really. I mean, we're still friends. We kind of talk here and there, but since we go to different schools now, we really don't talk too much. And I said, Tori, have you ever heard of the saying, you are the average of the top 5 people that you hang around with? And she says, no, I've never heard that saying before. And I said, you need to think about that. The top 5 people you hang around with, you become the average of those 5 people. So take a look at who you're hanging around with. Are you the smartest person in the room? If you are, you probably need to start getting into some other different rooms and create those relationships and continue to check in on your people, right? I mean, that's a big thing. Continue to check in, hang out, and just continue to bounce ideas off of one another. So that is all for this episode with the common FAQs part 2, clearing up some of the confusion. And I was I'm very, very excited about next week's topic. I am going to have a guest on next week. Okay, so come and join us. As a reminder, I will go live every Thursday, 9 a.m. Eastern time. And you can always catch the replays, catch the recordings as well. But I have a guest coming on next week. You don't want to miss that episode, especially for my investments. That's a big one. Everyone wants to talk about investing your money. So they're going to come on next week. And then when I was at the national park this past week, I visited the White Sands National Park in New Mexico. I had this really cool thought of another topic that I want to get into. And let me tell you what the topic is. Things that will take you far in business. And I have like a whole bunch of bullet points. I was just making some notes here. I'm very, very excited about that episode. So I think I'll do that the following week. And, I kind of just pick topics as they come to my head and what I'm feeling passionate about that day and just what I want to dive into. All right, I went a little long here on this episode. Actually, I'm kind of surprised. I was thinking about I wanted to go a little short, but now I think I'm waking up. It is now 8:06 over here in Tucson, Arizona. Just FYI, I'm going to go a little MIA starting this afternoon. Okay, my girlfriends are flying in from Orlando, and we're going to go camping in the desert. So don't call me, don't text me. I won't answer until Tuesday. No, if you do need me though, seriously, my assistant's going to be managing my emails. So you can send me an email, hannah@themoneymultiplier.com. If y'all got my cell phone number, send me a text. You can call me up as well. I'll be around. Just know that I am going to be a little hit and miss this weekend because we're going to go camping and just want to go and have some fun with the girlfriends this weekend. And Daisy's coming along too. Going to put on her harness and help. She's going to walk around with us. All right, y'all. Until next week, I will see you then. Do well. Be great. Think for yourself in question, okay? Think for yourself in question. And hey, as Mama TK always says, the choices you make today will affect your future. I'll catch y'all next week. Bye, y'all.